Hey everybody, Steven Sikowski here. I am the Chief Investment Officer and co-founder for Market Mastery Group. We're a team of people dedicated to teaching folks like you how to become more successful traders, how to potentially make money regardless of whether the market goes up, down, or sideways. I have been teaching these principles now for more than 3 decades, and here I am. I just absolutely love to share this information with folks. So let me tell you what I've got planned for you today. I want to talk to you about 8 different considerations that go into the taking of an options trade. You might think, wow, that sounds like a lot. Once you get the hang of it, it's pretty simple, and it is all very much rules-based. So, number one, when we are in the world of options, and I'm just now talking about buying essentially calls and puts, those are the 2 basic types of options. We buy call options on stocks going higher, put options on stocks going lower. So we are essentially making a bet in terms of direction. So the first thing that we need to establish is the trend. And the trend is all about technical analysis. And I do lessons on technical analysis, so I'm not going to go overboard on this. But let me give you just a quick preview. It's definitely worthwhile. And essentially with technical analysis, we are looking at charts. So we here, I'm pulling up a chart on DocuSign. All right, I'm just going to use a simple moving average here. And by the way, you can get a free sample of this software. Just come to one of my free webinars, and I'll tell you how you do that. So basically, that little blue line that you see right here, that is a 5-day moving average. You know what? I would much prefer for you, because you're not trading in that short of a period of time, let's use a 30-day. That's the best for people that are relatively new. There you go. Much easier to follow. So essentially, when we see that the security is above the moving average, we call that bullish. When it is below, it is bearish. And you can sort of see how that runs. When we look at like Netflix, right? Crosses up above the moving average. Notice how it bounces off the moving average. Many times moving averages act as support and resistance. So between looking at the moving average, the MACD, the relative strength index, all skill sets on balance volume, we can teach you how to be able to look at a chart and determine whether this stock is more likely to go up, down, or sideways. So number one thing that we have to consider when we are going to engage in an option trade, what is the trend of this stock? Or if you're trading ETFs, what is the trend of the ETF? Number 2, you've got to decide what type of an option you want to use. So you can pick an option that is in the money, which means on a call option, the price of the stock is higher than the strike price of the option you pick. At the money, where the strike price is the same as the price of the stock, or out of the money, where the price of the stock is lower than the strike price you pick on a call, and all this would be opposite on a put. Now, out of the money options are inexpensive. Out of the money options are great if you're going to make it a relatively short-term trade because you think this stock is going to move quickly. Problem with out of the money options is this: if you don't get a move in your favor, then you mount up losses pretty quick. So really the most conservative way to do it, if you can afford the option, is to pick an in the money option. But again, different options serve different purposes, and in class we can teach you which goes best given what you're trying to accomplish and your expectation for that stock. Then you got to pick an expiration date. So how far out do you want this option to last? Generally speaking, if you're doing out of the money options, probably going to go out about 90 days. In the money options, around 60 days. So when you go to an options chain, this is Netflix. So if I were going to do an in the money option and I were looking for something around 60 days, see, this is July, that's only 32 days. So I go to August, yeah, 74 days. But if I were going to do an out of the money, I may go out to September, which is 102 days. And it's because of the way that time decay works, and we don't really have time on this particular lesson to get into that. We will do that in a subsequent lesson for you. And of course, we cover it in great detail in our classes. But again, these are the 8 things you need to know. Then implied volatility. So one of the components of an option price is the implied volatility. When the markets are highly volatile, options are expensive. That's a good time to sell them. It's not a good time to buy them. And so we want to make sure that we check. We want to get in on a low implied volatility marketplace. And then you've got to know your exit. So people ask me all the time, I bought this call option. When do I get out? When your outlook changes is the bottom line. So if you're in a call option and the stock is moving up, when would you get out? When you're looking at a chart and your technical analysis says it's not likely for the stock to go up anymore. Harvest your profits. That's what you want to do. Just sell out and take your profits and run. Now, what if the stock doesn't go up? How far down are you going to let it go before you get out? And I always suggest that students use what is called a stop order. So if you don't want to watch it every single day, simply place a stop 35% below the price of your option. So if you played $10 a share for your option, right after you own that option, you can then come in and put in another order that says, hey, if the price of the option drops to $6.50, automatically take me out. You also have the opportunity to be able to roll your winners. So let's say that I buy an option and I purchase it for $10 a share and the value goes to $20 a share. I could sell that option and then reinvest in something again for say $10 a share, thereby locking in my profits. So regardless of what it is that you're doing, when you're buying an option, there are 8 different considerations. Number 1, what is the trend and your future forecast for the price? Do you want to go in the money, be more conservative, even though the options are more expensive? Out of the money, I never recommend that you buy. They're overpriced by definition. And then out of the money, if you think that the stock is going to move and move quickly. Pick the right expiration date. Out of the money around 90 days, in the money around 60 days. Buy when implied volatility is low and sell when implied volatility is high. Know your exits. And one of the ways to automatically trigger an exit is to use a stop order to protect your downside. By the way, you could also have a limit order on your upside. I have a friend of mine, he puts on a trade, and if it hits 100%, he's out. And if it drops 35%, he's out. I have another friend of mine, if it hits 100%, he takes half of his position off, keeps his original, and lets the rest run. You also have the ability to be able to roll your winning trades. So you can sell your position that you originally took, take part of your profit and use it to buy a whole new position. And also never be afraid to lock in profits. If I buy 10 contracts and the price is double, I can sell 5, locked in my profits, but I still have the other 5 working for me. Does that make sense? Do you really want to learn the right ways of being able to trade options? If so, I'd suggest, why don't you join me for one of my free 1-hour webinars. There's no cost, no obligation. Click on the link and register and learn a little bit more about us, about option trading and the way that we work with our students. I promise you, you will be glad that you did. Okay, so until next time, thanks for joining me. I hope that you enjoyed this, and go ahead and register, and I hope to see you at one of our upcoming presentations. Until then, God bless all.